Hello and welcome to our Global Investment Outlook for 2022. As we head towards the new year, new concerns loom large over the global economy. New restrictions related to rising infections in Europe and the emergence of Omicron variant will be a short-term drag, but shouldn't generate major economic damage. We have learned a lot from previous waves and have new tools and treatments to limit the impact on health systems. Such economic disruptions tend to delay, not destroy, demand and spending, and so they have a more measured impact on growth, jobs, and corporate profits. We therefore expect activity to catch up rapidly, monetary and fiscal support remains flexible, limiting potential losses from temporary closures. And if the new COVID wave is sustained, the Fed should act cautiously. But if not, the central bank should pursue its gradual monetary policy normalization, possibly at an even slightly accelerated speed. Overall, we remain optimistic on the outlook for 2022. We see a new phase of the cycle dawning with still strong growth momentum and a fair amount of catch-up potential, notably in services. Far from stagflation, the global economy is set to grow at one of its fastest pace in over 40 years in 2022, by 4.6% in the US, 4.5% in the euro area, and 5% in China. Inflation will remain high due to improving employment, higher wages and rents, but generally much lower than this year as most supply-side issues and energy costs are already easing. But a mid-cycle expansion is not without risks, from inflation surprises to monetary or fiscal policy missteps. Besides, this cycle is moving very rapidly, and late-cycle conditions should start to emerge in the second half of 2022. So how do we position our clients' portfolios with this in mind? Well, let's hear from Stéphane.
A mid-cycle phase usually sees higher market volatility and moderating asset returns. This cycle is also vulnerable to the evolution of the pandemic, as we see with the emergence of the new Omicron strain. We will continue to forge our opinion on its transmissibility, severity of disease, and possible vaccine resistance based on the latest scientific analysis. But for now, as Sami just said, nothing suggests activity will be durably affected, and we therefore expect a positive 2022 for risk assets. And this is exactly why we keep a pro-risk portfolio positioning. We maintain our overweight position in equities, emerging market debt, and high-yield credit, all at the expense of high-grade fixed income and gold, where we are underweight. Within equities, we still have higher allocation to cyclical and value stocks, and we prefer pan-European names and small capitalizations. Inflation and interest rate expectation justify a defensive stance in our fixed income holdings. We have further reduced developed market government bonds and high-quality credit in favor of credit in Asia, which looks more attractive after the recent sell-off linked to the Evergrande situation. In currency markets, we expect more pronounced differentiation as support from central banks fades and rates start to rise. We are factoring in a stronger dollar and a weaker euro in 2022. Infrastructure could get a boost next year as governments across the developed world deploy new spending plans, including investment in more sustainable production and transportation. That will further increase investors' focus on sustainability. As the world economy transitions to net zero, we believe that mitigating risk, identifying transition leaders, and funding reinvestment is key in delivering performance for our clients. The stakes of the climate transition are high, and with the next COP27 in Sharm el-Sheikh in late 2022, countries will be under pressure to not only commit to more ambitious net zero target, but also to deliver on concrete action plans. The economic cycle is moving swiftly as we approach year-end. That means that more volatility is inevitable in 2022, and geopolitical dynamics will of course play a role, whether US-China relations, European politics, or the nuclear negotiation with Iran. Overall, our investment outlook remains constructive, and we monitor risk closely and stand ready to adjust our positioning whenever needed. There is no alternative to an active approach associated with strong investment discipline. Thank you very much for watching, and we wish you and your family a very happy holiday season.